Most people think they understand life insurance, but these 5 mistakes could leave their family with absolutely nothing. And if you're watching this, you're probably making at least one of them right now. I'm going to show you exactly what these mistakes are and how to avoid them, because unlike my last video about car loans where we talked about protecting your credit, today we're talking about protecting your family's entire financial future. Welcome back to Monetary Map, where we break down financial topics without the fluff. I'm your host, and today we're covering the 5 biggest life insurance mistakes that could cost your family everything. These aren't just theoretical problems, these are real mistakes I see people making every single day. Mistake number 1. Buying way too little coverage. Here's the brutal truth: most people only think about immediate debts like funeral costs or maybe their mortgage. But that's not even close to enough. Here's the real formula you need to know. Take your annual income and multiply it by 10 to 15. So if you make $50,000 a year, you need at least $500,000 to $750,000 in coverage. Why? Because your family needs to replace your income for years, not just pay off debts. The DIME method breaks this down: debt plus income replacement for the years your family needs support, plus mortgage balance, plus education expenses for your kids. Then subtract your current savings and existing insurance. That gap? That's what you actually need. Most people buy $100,000 or $200,000 thinking it's enough. It's not even close. Mistake number 2. Choosing the wrong policy type. Mistake number 2. Choosing the wrong type of policy completely. There are 2 main types: term life and whole life, and picking the wrong one can waste thousands of dollars or leave you unprotected. Term life insurance is temporary coverage for 10, 20, or 30 years. It's cheap and simple. Whole life is permanent coverage that builds cash value but costs way more. Here's the truth: if you're just starting out or have temporary needs like a mortgage or young kids, term life is almost always better. It's 5 to 10 times cheaper for the same death benefit. You can get $500,000 in term coverage for what you'd pay for $50,000 in whole life. The insurance industry pushes whole life because they make more money, but for most people under 40, term life is the smart choice. Don't let anyone convince you otherwise without showing you the math. Mistake number 3. Never updating beneficiaries. Mistake number 3. Never updating your beneficiaries. This one is absolutely critical and most people completely ignore it. Your beneficiary is who gets the money when you die. Sounds simple, right? But here's what happens: you get married, have kids, get divorced, remarry, and you never update your policy. So your ex-spouse gets the money instead of your current family. Or your parents get it instead of your spouse and kids. Even worse, if you don't name a beneficiary at all, the money goes to your estate and gets stuck in probate court for months or years while your family struggles financially. Check your beneficiaries right now. Seriously, pause this video and check. Update them after every major life event: marriage, divorce, new kids, deaths in the family. This takes 5 minutes and could save your family from financial disaster. Mistake number 4. Relying only on employer coverage. Mistake number 4. Relying only on your job's life insurance. Most employers offer some life insurance as a benefit, usually 1 to 2 times your annual salary. People think this is enough. It's not. First, it's usually way too little coverage based on what we talked about in mistake number 1. Second, and this is huge, you lose it when you leave your job, retire, or get laid off. Right when you might need it most. Plus, employer life insurance rarely lets you take it with you. So you're starting over at an older age when insurance costs more and you might have health issues that make you uninsurable. Use employer life insurance as a supplement, not your main coverage. Get your own policy that you control and can keep regardless of your job situation. Mistake number 5. Shopping on price alone. Mistake number 5. Buying based on price alone. I get it, life insurance feels like you're paying for something you hope you never use. So people shop for the cheapest option. But the cheapest policy often means the worst coverage when you actually need it. Some companies have terrible claim processes, exclude common causes of death, or have financial stability issues. Here's what to look for instead: AM Best rating of A or better for financial strength, clear policy terms with minimal exclusions, and a company with a good reputation for paying claims quickly. Yes, you might pay 10 or 20% more, but that's nothing compared to your family getting denied a claim because you chose a sketchy company to save $50 a year. So there you have it, the 5 life insurance mistakes that could cost your family everything. Unlike the car loan strategies we covered last time where you're protecting your credit score, life insurance is about protecting your family's entire financial future. Don't make these mistakes. Calculate your real coverage needs, choose term life if you're starting out, update your beneficiaries regularly, get your own policies separate from work, and don't shop on price alone. If this helped you avoid even one of these mistakes, hit that like button. Subscribe for more no-fluff financial advice, and I'll see you.